Welcome to this explainer on one of the most heavily tested and, frankly, most impactful areas in technical accounting, leases. For years under legacy GAAP, companies could structure agreements to keep massive financial obligations completely hidden. But the rollout of ASC 842 changed the game entirely. The standard was issued for one simple reason. Bringing operating leases onto the balance sheet drastically improves transparency regarding a company's total assets and its leverage ratios. Suddenly, investors could see the true financial commitments a business had actually made. So today, we are going to master the standard, from the basic definitions all the way to the most complex journal entries, so you are totally equipped for the bar exam. Here is our quick roadmap for today's Foundations lecture. We're going to hit Section 1, the lease definition and our core mantra. Section 2, the 5 classification criteria. Section 3, accounting treatments for both sides of the deal. And finally, Section 4, sale and leaseback transactions. Let's jump right in. All right, Section 1. Let's lay the groundwork by nailing down exactly what a lease is. Now, you might think a lease is just casually renting something, right? Well, not exactly. The specific language the standard uses here is super important. It defines a lease as a contract conveying the right to control the use of an identified asset for a period of time in exchange for consideration. The absolute operative word you need to zero in on is control. To actually have a lease, the lessee has to obtain substantially all of the economic benefits from that asset, and they must have the right to direct exactly how and for what purpose that identified asset is used throughout the term. If you don't have control of an identified asset, then you simply have a standard service contract. It's not a lease, and ASC 842 does not apply at all. Okay, I need you to literally burn this next quote into your memory for exam day. This is our absolute mantra for this explainer. Classification drives treatment, treatment determines impact. The entire ASC 842 accounting standard hinges on getting that initial sorting step right. If you misclassify a lease on day one, you know what happens? Every subsequent journal entry you make is going to be wrong. Your expense patterns will be wrong. Your balance sheet will be entirely inaccurate. So the big question is, how do we guarantee we get that classification right the first time? Well, that brings us straight to Section 2, the 5 classification criteria. Think of these 5 criteria as a diagnostic filter that every single lease contract absolutely must pass through. You test them in order, and the rule is totally black and white, meeting just one of these triggers a finance lease for the lessee or a sales-type lease for the lessor. Number 1, does the title transfer to the lessee at the end of the lease? If you get to keep it, you'd basically bought it. Number 2, is there a purchase option that the lessee is reasonably certain to exercise? Number 3, is the lease term for a major part of the asset's remaining economic life? On the exam, this commonly means 75% or more. Number 4, does the present value of the lease payments, plus any guaranteed residual value, equal or exceed substantially all of the asset's fair value? The common threshold you'll use here is 90% or more. And finally, number 5, is the underlying asset of such a specialized nature that it has absolutely no alternative use to the lessor at the end of the lease? Again, hit any single one of these 5 hurdles, and boom, you have effectively purchased or sold the asset from an economic and accounting perspective. So now that we've got our sorting rules locked in, let's move to Section 3 and look at the actual financial outcomes for both the lessor and the lessee. Let's start with the folks who own the asset, the lessors. Lessors have 3 potential classifications. First, if any one of our 5 criteria is met, it's a sales-type lease. The lessor is essentially selling the asset outright, so they must derecognize it from their books and recognize upfront selling profit immediately at commencement. They'll also recognize interest income over the lease term. But what if absolutely none of those 5 criteria are met? Well, before you automatically default to an operating lease, you have to check for a direct financing lease. This happens if the present value of payments plus a third-party residual guarantee substantially equals the fair value and collection of the payments is probable. In this highly specific edge case, the lessor does not get to recognize upfront profit. Instead, they only recognize interest income over time, basically treating it strictly like a pure financing arrangement. Finally, if a lease meets neither of those hurdles, then it's an operating lease. The lessor simply keeps the asset on their own books, continues to depreciate it normally, and records smooth, straight-line rental income over the lease term. All right, let's flip it and look at the lessee side. Remember our mantra, classification drives treatment. For lessees, ASC 842 mandates that virtually all leases go straight onto the balance sheet at commencement. You're going to record a right of use, or ROU asset, and a corresponding lease liability. Both of these are initially measured at the present value of the lease payments. And quick note on that calculation, you must use the rate implicit in the lease if it's known, otherwise you just use the lessee's incremental borrowing rate. Now, while the balance sheet treatment looks pretty similar either way, the expense recognition on the income statement differs wildly based on those 5 criteria. If just one criterion is met, it's a finance lease. You'll record interest expense on the lease liability plus a separate amortization expense on the ROU asset. Because interest is naturally higher in the early years when the liability is at its largest, this results in a very front-loaded total expense pattern. If no criteria are met, it's an operating lease. You still have the ROU asset and liabilities sitting pretty on the balance sheet, but your income statement will show a single, smooth, straight-line lease cost every single year. Now, I should mention, there is one small but highly testable carve-out for lessees. It's called the short-term exemption. This allows a lessee to elect not to recognize an ROU asset and lease liability if the lease term is 12 months or less, and it doesn't include a reasonably certain purchase option. If a company elects this, they just record straight-line rent expense as they pay it, and the entire obligation stays completely off the balance sheet.
Let's make this concrete. We're going to walk through a practical example to see exactly how this hits the books.
Here is our fact pattern. A company enters into a lease agreement with Lakeshore Equipment Leasing. Lakeshore, our lessor, has a cost basis in the equipment of $50,000. The fair value of the equipment today is $65,000. The present value of the lease payments the lessee will make is calculated at $62,000. Meanwhile, the total undiscounted cash payments over the life of the lease will be $72,000. Take a good look at these figures. As a BAR candidate, how are you going to classify this? While we pull out our 5 criteria test, if we divide the present value of the lease payments, which is $62,000, by the fair value of the asset, which is $65,000, we get roughly 95%. That safely clears our 90% fair value threshold, right? Because it meets one of the 5 criteria, our classification is firmly locked in. So, what happens on day 1? Step 1 is our classification. For Lakeshore, the lessor, this is definitively a sales-type lease. For the lessee, it's a finance lease. Step 2 is Lakeshore's day 1 journal entry. Because it's a sales-type lease, they must completely derecognize the equipment and record immediate selling profit. That profit is the present value of $62,000 minus their cost basis of $50,000. That equals exactly $12,000 in upfront profit recognized on day 1. Plus, they will recognize interest income over the remainder of the term. Step 3 is the lessee's day 1 entry. They will debit a right-of-use asset for $62,000 and credit a lease liability for $62,000. Going forward, the lessee will recognize that front-loaded expense via interest and amortization, which is totally different from the smooth, straight-line expense of an operating lease. Keep in mind, exam questions may use messier numbers than these, but the logic stays exactly the same. Finally, let's pivot to Section 4, Sale-and-leaseback transactions. This is a critical edge case that trips up candidates all the time. It happens when a company sells an asset they own to a buyer and then immediately turns around and leases that exact same asset back from them. To accurately solve one of these, you actually don't start with lease accounting. You start with revenue recognition. You have to ask one pivotal question. Has control transferred to the buyer under ASC 606? If control hasn't transferred, a true sale has not occurred. And by the way, control automatically fails if the seller has a repurchase option or if the subsequent leaseback meets the criteria to be a finance lease. Why? Because if you are immediately taking back a finance lease, you are legally retaining substantially all the economic benefits of the asset. You never really gave up control in the first place. This leads to 2 very different outcomes. If control fails to transfer, you have what's called a failed sale. Do not derecognize the asset. The asset stays right there on the seller's books, and any cash received from the buyer is simply recorded as a financial liability. It is effectively a disguised loan, a financing arrangement, plain and simple. If, however, control actually does transfer, it is a real, true sale. The seller derecognizes the asset, recognizes a gain or loss on the sale, and then separately records a brand new ROU asset and lease liability for the operating leaseback portion of the transaction. Now, this brings us to a massive trap you will likely see on the bar exam. Let's say a company sells an asset for way above its fair value, or they sign a leaseback with rents that are way below market rate. Examiners will try to trick you into saying this automatically fails the sale. It does not. Our critical accuracy rule states that off-market terms never ruin a sale all by themselves.
If control is transferred under ASC 606, it is a sale. You simply adjust for the off-market terms. If the sale price is above market, that excess amount is treated as additional financing provided by the buyer lessor. If the sale price is below market, it's treated as prepaid rent. Never, ever assume off-market pricing alone makes it a failed sale or a disguised loan. Which brings us right back to where we started today. Classification drives treatment, treatment determines impact. Whether you are looking at the 5 criteria for a standard lease, figuring out the proper discount rate, or evaluating control in a tricky sale and leaseback, getting that initial sorting step correct is the absolute key to unlocking the entire problem. Just ask yourself, who truly controls the asset and what are the underlying economic realities of the contract? If you anchor yourself to this framework, you'll be able to navigate through absolutely any complex lease scenario the bar exam throws your way. So, are you ready to test this logic on your next practice simulation?